Yes, so we go back. Let's wrap it up on the side of the consumers. What lies ahead in 2019? Do you see a likelihood of the MITO tariff review before the end of this year?
Well, I think it has to happen. It has happened because what has been happening is that the shortfall has basically been filled by the government, which is another subsidy essentially. So, and given the current state of the government in terms of revenue, they simply don't have the wherewithal, the capacity to continue to pay for such right now. So I think post-election in this year, after February, or even maybe after swearing in, we will see some form of review in that space. And what will then happen is we will see significant jump. What should have been a marginal increase over the past 4 or 5 years would then be a significant jump. So we're expecting an increase in the range of between 60, 70, 80% increase in tariff. Okay. That's quite unfortunate because these are increase that should have been incorporated over the years, maybe a 10%, 20% increase on an annual basis.
Yeah, got your point. It's just going to be what you call the compounded one, isn't it? We'll be biting a bigger bullet where we should have just bit it in bits and pieces over a period of time. Thank you very much, Jubril Karim, energy research analyst at EcoBank, Nigeria. Let's come back to the marketplace. Yesterday, it was a bit bearish. The bond market at the secondary window for Treasuries, we saw a bit of widening in yield to about 15.44% on Treasuries and about 15.36% on Naira bonds. That's part of the big stories across the markets. The stock market was bearish on one side, and we thought, starting the week after the Christmas and long holiday into the new year, that the fixed income market would sidestep the nervous, nail-biting behavior of investors in equities. But it looks like we're having a bit of that nervousness creeping into our fixed income market. Let's talk to Thaddeus Udegbe, who is of UBA, is joining us via Skype from FMDQ Exchange Place. Thaddeus, if you're there, good morning. Welcome to the program.
Good morning, person.
Yes, it looks like the nail-biting equities market bearishness is beginning to show a little bit on the fixed income on the debt market street.
Thank you. Yeah, coming into this week, if you looked at the yield curve on Monday, you find that the yield curve was looking humped on the short end. You find that yields on the short ends were practically trading higher than the yield on the long end. You find the shortest bucket of the yield curve, the 1 year, trading at about 17%, while the 20-year bucket was trading at about 15.6%. As at close of business yesterday, we saw that trend has changed. We saw that the yield curve seems to have normalized, with the short end coming pretty down to about 15%, while the long end was about 15.5 also. So we saw that the long end of the yield curve was pretty flat, while the short end of the yield curve, the yield inched downwards. This is as a result of the liquidity injections that we had yesterday. Yesterday, the market got a boost. Money market liquidity got a boost of about 583 billion from Treasury bills maturities. That also influenced investors' appetite and sentiment in the market, and so we saw some positive demand coming in on the short end of the yield curve.
Yeah, if there's liquidity in the market, then why do we have a bit of a bearish sentiment in terms of yields?
Yeah, the bearish sentiment you talked about, it's on some of the maturities, not across the yield curve, on the short end. Of course, you know that on Monday there was OMO auction. The central bank offered 217 billion, but it was able to take out 18 billion. That, on the subscription level, made the central bank to also do a special OMO, where it took out additional 135 billion on Monday. So that created the bearish sentiment on some maturities, specific maturities that were reopened at the OMO. Also, on Wednesday, we saw a primary market auction for Treasury bills on specific maturities, where the central bank offered 74 billion and took out 74 billion for 91 day, 182, and 364 day at various rates. Also, on Thursday, we also saw another OMO in response to the liquidity that we saw yesterday, the maturities that I just mentioned. So the central bank conducted OMO. Central bank offered about 450 billion, but central bank was able to take out a mega sum of 240 billion. And due to the perceived under-subscription, the central bank also did an additional special OMO sales. That created the panic you saw in the market. So on those specific maturities where the central bank reopened at the OMO, we saw those bearish sentiments.
Okay, so finally, Thaddeus, is there there are pressures coming in from the external global markets, uncertainties that is beginning to show their hands, as it were, on the currency and the debt markets. Do you think we're beginning to see a bit of that nervousness from the global space creeping into our market street?
Well, we haven't seen much of an interest from the FPIs. If you recall that towards the end of Q4 2018, we noticed that there was risk aversion on the part of the FPI. So we didn't see much of activities from that end. And of course, the uncertainty into 2019 being an election year for Nigeria. So we don't expect to see much of an interest or activities from that segment of the investors. So we believe that what would drive activity in Q1 will be domestic demand from FPF, pension funds and banks, given that some of these institutions have regulatory need to invest in government securities.
Okay. Thank you so much. Thaddeus Udegbe, a fixed income dealer from UBA, speaking to us from FMDQ Exchange Place. Temple Ashaji will be speaking to us from the Nigerian Stock Exchange trading floor after the break. And it's been a little bit of an unhappy first trading week for equities in the new year. It was all a happy new year, but stocks don't look happy. And not just here, but all over the world.